If you're self-employed and trying to get a mortgage, you've probably already realized that the process feels more complicated than it should. You might earn good money, have a decent deposit, and still be told you can borrow less than expected, or struggle to get a clear answer at all. In this video, I'm going to explain how self-employed mortgages really work in the UK in 2026, what lenders actually look at, and why so many applications fall down simply because people misunderstand how their income is assessed. Quick note before we start. This is general information, not personal financial advice. Mortgage eligibility depends on your individual circumstances and lender criteria at the time. The first thing to understand is that self-employed isn't one category. Lenders treat sole traders, partnerships, limited company directors, and contractors very differently. The mistake many people make is assuming all lenders assess self-employed income the same way. They don't. If you're a sole trader or in a partnership, lenders usually look at your net profit, not your turnover. Most lenders will average your profits over the last 2 years, although some will use the most recent year if it's higher, and others will reduce income if profits are falling. This means a strong recent year helps, but consistency still matters. If you're a limited company director, things get more nuanced. Some lenders only look at salary and dividends. Others will also consider retained profit within the business. Applying to the wrong lender can massively reduce how much you can borrow, even if the business itself is healthy. This is one of the most common causes of frustration for directors. Contractors can fall into different categories again. Some lenders treat contractors as self-employed, while others assess income based on day rate multiplied by weeks worked. The way your contract is written, how long you've been contracting, and gaps between contracts can all influence which lenders are available. Next is documentation, and this is where a lot of time is lost. Lenders need evidence that income is sustainable. That usually means SA 302s and tax year overviews for sole traders, or full company accounts for directors. Missing documents, inconsistent figures, or accounts that don't match tax returns can all slow things down or lead to declines. Another issue is declining income. Even if you're earning well now, lenders often look backwards. If profits are dropping year on year, some lenders will reduce the income they're willing to use, or decline altogether. That doesn't mean a mortgage is impossible. It means lender choice becomes more important. Then there's tax efficiency versus borrowing power. Many self-employed people quite rightly minimize tax by keeping income low. The downside is that mortgage affordability is based on declared income. Paying less tax can reduce borrowing capacity. There's no right or wrong approach here, but it's important to understand the trade-off before you apply. Bank statements matter just as much for self-employed applicants as they do for employed ones. Lenders look for consistency, regular income, and sensible spending patterns. Large unexplained transfers, frequent overdraft use, or personal spending that doesn't match declared income can all raise questions. Timing also matters. Applying before accounts are finalised, during a quiet trading period, or just after a big change in income can make things harder than they need to be. Sometimes waiting a few months can significantly improve outcomes. So, how do you improve your chances? First, understand how your income will be assessed before you apply. Second, make sure your documents are complete and consistent. Third, don't assume all lenders will treat your income the same way. And fourth, be realistic about the balance between tax efficiency and borrowing power. Being self-employed doesn't mean you can't get a good mortgage. It just means the application needs to be structured correctly and placed with the right lender. When that happens, the process is far smoother and far less stressful. If you found this helpful, subscribe for more straight talk videos covering UK mortgages, self-employed lending, and borrowing decisions. In the next videos, we'll look at whether to buy now or wait, and when remortgaging actually makes sense in 2026. Thanks for watching. One mistake people make is focusing only on the headline rate. A tracker might look cheaper today, but that doesn't mean it will stay cheaper. A fixed rate might look more expensive now, but it protects you from future increases. The right comparison is the overall cost and risk over time, not just the starting number.